What if I told you that just $5 a day could turn into over $100,000? It may sound crazy, but with smart investing and the power of compound growth, it's not only possible, it's happening for those who start early. Here's the kicker. Over 60% of Americans don't invest at all, which means the majority are missing out on one of the easiest ways to build wealth in 2025. Let's change that today. Are you ready to stop letting your money sit idly and start making it work for you, even while you sleep? The game is changing in 2025, and you have a fantastic opportunity to take action now. If you are watching this, you likely want to grow your money but feel overwhelmed by financial jargon and the fear of losing it all. You've probably come across terms like ETF, Roth, IRA, or diversified portfolio and thought, this is too complicated for me. Or perhaps you have postponed investing because you think, I don't have enough money, or I don't want to lose everything during a market crash, or I will start when I make more. Let me be blunt. That mindset is holding you back from achieving financial success. Here is my promise. By the end of this video, you will know exactly how to start investing in 2025, even if you are beginning with $50 or less. No confusing terms. No guessing games. Just a clear roadmap. This isn't about get-rich-quick schemes or risky bets. It's about legitimate, proven strategies that allow you to build wealth steadily, securely, and smartly. I will break down the investing world into simple, easy-to-understand steps that anyone can follow, transforming your financial future from uncertain to incredibly exciting. Step 1. Get your financial house in order. The unshakable foundation. Before investing in the market, you need to have a solid financial foundation. Think of it like building a skyscraper. You wouldn't start with the penthouse before laying the groundwork. Actionable advice. Build your emergency fund. Aim to save 3 to 6 months' worth of essential living expenses, including rent or mortgage, utilities, food, and transportation, in an easily accessible, high-yield savings account. This fund acts as your financial safety net. If life throws you a curveball, such as job loss, a medical emergency, or a car repair, you won't have to sell your investments at a loss or go back into debt. Set up your budget if you haven't already. You need to know where your money is going and how much you can realistically allocate to investing each month. Even starting with $50 a month can make a significant impact. Relatable analogy, imagine you're preparing for a long journey. You wouldn't set off with a flat tire and an empty fuel tank. Your financial foundation should be like a fully inflated tire and a full tank of gas. Step 2. Understand your why, your investment North Star. Why are you investing? Understanding your purpose will shape your investment strategy, risk tolerance, and the time frame for your money's growth. Actionable advice. Define your goals. Are you saving for retirement, the most common and impactful goal, a down payment on a house, your child's education, or a dream vacation in 5 years? Each goal has a distinct timeline, necessitating a customized investment approach. Determine your timeline, short-term, 1 to 3 years. Money you need soon should not be invested in the stock market. What if I told you that just $5 a day could turn into over $10,000? Medium term, 3 to 10 years. This money can be invested in less volatile assets, such as a mix of bonds and diversified stocks. Long term, 10+ years. This is where the stock market can truly work its magic. Retirement savings, for example, are ideal for this time frame. Assess your risk tolerance. How comfortable are you with the fluctuations in the value of your investments? While everyone experiences some level of anxiety about market swings, some individuals can manage more volatility than others. This isn't about being reckless. It's about recognizing that higher potential returns often come with increased short-term risks. For example, if you are saving for retirement in 30 years, you can afford to take a more aggressive approach with stocks. However, if you need to save for a house down payment in 3 years, a volatile stock portfolio may be too risky. Step 3. Open the right account. Your investment gateway. Now that you have a strong foundation and clear goals, it's time to choose the right investment vehicle. This is not just any regular bank account. Actionable advice, retirement accounts, tax-advantaged, your best friends, 401k or 403b, if your employer offers one of these plans. This is often your first step, especially if they provide a matching contribution. This is essentially free money. Be sure to contribute enough to receive the whole match. Your contributions are made with pre-tax dollars, which lowers your taxable income for the current year. Roth IRA for many beginners, particularly those starting early in their careers. A Roth IRA is invaluable. You contribute money after taxes, but all your investment growth and withdrawals in retirement are completely tax-free. Imagine never having to pay taxes on your investment gains. Traditional IRA, similar to a 401k. Contributions to a traditional IRA are often tax-deductible now, but withdrawals will be taxed in retirement. Brokerage account, taxable for non-retirement goals. This is a standard investment account that allows you to buy and sell a variety of investments. It's suitable for goals outside of retirement, such as saving for a down payment on a house or building wealth that you might want to access before age 59 and a half. Keep in mind that all gains in this account are taxable. Choose a reputable brokerage. For beginners, consider user-friendly platforms with low fees and solid educational resources. Consider names like Fidelity, Vanguard, Charles Schwab, or even modern apps like Robinhood, but be cautious about the high-risk options available on these platforms. Key concept: tax-advantaged accounts are incredibly beneficial because they either provide a tax break now or later, allowing your money to grow faster. Don't leave free money on the table. Step 4. Pick your investments. Simplicity is your superpower. Many beginners feel overwhelmed at this stage. They often think they need to pick the next Amazon or Apple. This is not the case. For 99% of long-term investors, simplicity and diversification are the keys to success. Actionable advice. Index funds and ETFs, these are your secret weapons. Instead of buying individual stocks, which can be risky for beginners, index funds and ETFs act like baskets that hold hundreds or even thousands of different stocks or bonds. By investing in an S&P 500 index fund, you essentially own a small piece of the 500 largest companies in the U.S. Why they are great? They offer remarkable diversification, spreading your risk, have very low fees, and have historically performed well over the long term simply by tracking the overall market. Target date funds for retirement accounts. These funds are excellent for retirement savings. You select a fund based on your anticipated retirement year. The fund manager automatically adjusts the asset allocation, stocks versus bonds over time, becoming more conservative as retirement approaches. It's a perfect set and forget it option. Avoid individual stocks initially until you fully grasp market research, company financials, and your risk tolerance. It's wise to steer clear of picking individual stocks. Doing so can lead to quick losses for beginners. Automate your investments. Set up automatic transfers from your bank account to your investment account with every payday. Even $50 or $100 a month can add up over time. This strategy, known as dollar cost averaging, helps smooth out market fluctuations. Analogy: investing in a single stock is like betting on a particular player in a basketball game, while investing in an index fund is like investing in the entire league. Even if one player has a poor performance, the overall league tends to do well over time. Step 5. Embrace the long game and ignore the noise. Patience is profitable. Investing is a marathon, not a sprint. One of the biggest mistakes beginners make is panicking during market downturns or trying to time the market. Actionable advice. Understand market fluctuations. The stock market naturally fluctuates, and that's normal. Try not to check your portfolio every day. Focus instead on the long-term trend. Market corrections and downturns are a typical part of investing and can even present opportunities to buy more shares at a lower price. Stay invested, especially during downturns. Resist the impulse to sell when the market drops, as this locks in your losses. Historically, the market has always recovered and continued to reach new highs. Exercise patience. It pays off. Avoid chasing trends. Don't get caught up in the latest hot stock or trendy investment. Stick to your diversified, low-cost index funds. Remember, slow and steady wins the race. Review annually. Take the time once a year to review your portfolio. Are you still on track to meet your goals? Do you need to adjust your contributions? This review is not about constant tinkering. it's a periodic checkup. For example, during the 2008 financial crisis, many people withdrew their money from the market out of fear. However, those who stayed invested or even continued to invest saw their portfolios recover and grow significantly in the years that followed. Mindset shift, beyond money, the deeper transformation. As you consistently implement these steps, you will experience a profound transformation that goes far beyond just your bank account. Confidence soars, investing, even with small amounts, shifts your mindset from being a consumer to becoming an owner. Instead of merely spending, you are now building your wealth. Decisions become strategic. When you see your money working for you, every dollar takes on greater significance. Freedom to dream bigger. Investing is about purchasing your future freedom, whether it's a comfortable retirement, pursuing passions, or feeling secure in life's challenges. Money invested today represents time, peace of mind, and the ability to embrace opportunities. You have a step-by-step blueprint for starting to invest in 2025. Don't let regret hold you back. Are you ready to make your money work for you? Take action today by setting up your emergency fund, defining your investment goals, or opening your first account. If you found this guide helpful, subscribe for more smart money tips and motivation to achieve your financial dreams. What's your first investment goal? Your journey to financial freedom starts now. Let's make 2025 the year of transformation. Investing empowers you to control your time and future. Don't wait another year. Start building today. You have got this.